Hey everyone, this is a trader investor. Today I want to talk about Forex. I want to talk about Forex because many retail investors, retail traders are really struggling to be profitable, to be consistently profitable with Forex. Forex is just any other, it's very similar to any other instrument. It moves in a trend, it moves sideways. It moves in a trend, it moves sideways. There is accumulation, there is distribution. Then there's trend in between. So very similar structure, area of value, execution to any form. What makes Forex interesting to many is the leverage that we have. Usually a standard lot size, for example, is $100,000 in terms of dollars, and so with a 1% account leverage for $1,000, we can control $100,000. That's what makes it interesting and enticing for many to enter the Forex market. And for that $1,000 leverage, for that margin amount, we are able to control such a large size that when price moves, we can gain a lot or we can lose a lot at the same time. So because the losses are high, and the losses are high because many people don't understand structure, don't understand area of value. And the next thing I will mention is the highest thing that most traders fail to understand is smart money banks manipulate the market, manipulate not in a bad way, but they manipulate it to find liquidity, which comes in forms of stops. So they hunt those stops. They manipulate by buying to go short. They buy first to go short, or they sell first to go long. And when they're manipulating it, many traders think that, oh, the banks are going short, I'm going to go short. Price reverses immediately and hits their stops. And if we don't understand where these manipulation points are, this is where it becomes dangerous to become a Forex trader. This theory works in every market, but because of the leverage in Forex, the losses are magnified. And that's why I want to talk about Forex in these terms. So earlier last week I did an explanation of order blocks. So these order blocks is what I mentioned a minute ago, where the buy happens before that big drop or the sell happens before that big rise. So those are order blocks, and here in this video I will explain briefly how the order blocks are found on the charts, how they're derived, and then how we can enter properly using those order blocks. Those order blocks for us will become our support and resistance. We no longer just blindly say, hey, I see this zone as support and resistance. When price comes down here, I'm going to enter long. We are no longer going to blindly say that. Or from the bottom, when it comes here as a resistance, we are no longer going to blindly enter short positions. Because this is how we've been taught, and this teaching has led us to believe, oh yeah, here by just looking at this portion, one time if I had done this, boom, I am good to go. But how would you know that this was an area of value until you go back here for a couple of years and you maybe have drawn this as an area of value and you have entered and it has worked one time. The next time it came down here, depending on how quickly you pulled the trigger, maybe you stayed in, maybe you didn't. Depending on where your stop loss is, maybe you're in, maybe you're stopped out. So most people will put their stop near these lows and as you can see, they were stopped out. So why is that? And then here it worked. Wow. So one time it worked, one time it didn't work, one time it worked, and then the next time it didn't work because again these lows we are stopped out. So do we want to take these chances, or do we want to get an edge? Do we want to put the stack in our favor so that we can go long at the appropriate time? This is what I want to talk about today, is finding those strong support and resistance left as a trail by the banks. We'll use those bank support and resistance lines to go short or long. That's one. Number two, we will go long in the broader market structure being long, and we will go short in the broader market structure being short. And when we're going short, we will use the other side of the order blocks as our first target, target one. And then we let the rest ride, we move our stops, and we can capture the movements. And I will start by looking at the daily chart, show you where those order blocks are. We can pull the trigger on the daily charts. We can pull the trigger on the hourly, on the 30 minutes, 15 minutes, 5 minutes, 1 minute. The theory and how we pull the trigger does not change at all. The only thing that changes is the amount of time that is required for you to monitor each trade. So for me, for example, I don't want to be glued to charts. You will hear me say this in many of my videos. I do not stare at charts. I want to look at charts maybe at, worst case scenario, every 15 minutes during normal cash US index hours, right? So that's 9:30 to 4 p.m. Eastern time. At the very worst, every 15 minutes, but at the very best, every hour. That's all I want to look at when I'm looking at charts. I don't want to spend 5-minute charts. Is just too many 5 minutes in 1 hour for me to look at. 15 minutes chart is only 4 of them that I will look at, but even that is something that I hardly use. I want to use the 1 hour chart. That's my favorite entry. The daily chart is my setup, and my hourly chart is my trigger, because then I only have to monitor it 2 minutes every hour. This is my focus area. So we will start by looking at the daily. We will go down to the hourly to explain how the theory works the same, how we can use that as a trigger, and we can also just take a few minutes and look at lower time frames just for the lesson purposes. But here's what's important. Here are 2 things that we must know. This does not change. So price sometimes consolidates. So we'll talk about different phases of the market. Price at times consolidates. So as it's consolidating and it comes to this area, the most logical thing that is in our mind, because this is what we've been taught, buy at support, sell at resistance. Buy at support, sell at resistance. Very good lesson, except what happens when institutions decide they're going to take this price down first. Then if you had just bought at this touch here, you're out, because your stop is somewhere here. So you're out. And then institutions then decide they're going to take price back up here. What happens? These longs are out, and these shorts, people who said, hey, this trend is broken, I'm going short, they're also out because their stop is somewhere here. So now banks have found liquidity in this zone on both sides, and they have taken it out. Banks know these liquidities. They don't know that the trader investor has entered this trade. What they do know is overall from every broker, the accumulation of trades, how many stops are for longs, how many stops are for shorts, and they have this level 2 data, the market depth. They know this information, and what this sets them up is to know where can they hunt for stops and take price where they want it to go. This is critical to understand. If we understand this, then we're able to make some smart decisions. So let's not get caught in this wild moves because we get faked in to think that this is a reversal. We get faked in to believe that this is a new trend forming. That's not what we want. We want to get out of these positions and be able to follow the trail. Boom, boom, that's where we enter. That's very, very critical to understand. And this can happen again when we reach here. When we reach here, then some will say, I'm gonna go short. And the market will say, I'm gonna go short, but before I go short, I'm going to fake you out and make you believe that your trade is bad, and you have your stop here. I'm going to make you believe your trade is bad, and I'm going to stop you out. And then there's another trader, another set of retail traders who thought they're going to go long, but the banks have decided they really want to take the price down. That's their goal. And those longs who have their shorts here are already out. So as you can see on both sides, they have been manipulated out. The goal is not to manipulate the trader investor. The goal is to manipulate the unsuspecting, very vulnerable retail trader. So we don't want to be that trader. So we want to make sure we don't get caught in this dichotomy, right? We want to make sure we get caught on the right side. So this is what happens when you are in a consolidation. In an uptrend, same thing happens in an uptrend. Price moves from trend to trend, and what you don't want to do, you don't want to get caught shorting or going long before the banks have manipulated unsuspecting traders. Critical to understand this. That's step number one. So then the next thing to understand is, when do we know that this market is done doing what it needs to do? So let's go back to our consolidation ranging example. In this example, price was here, touched twice, and then came back, came down here. So in here, we want to make sure that the structure, the downward movement structure, is broken. How do we know the structure is broken? So we form a trend line, and when price breaks that trend line, step one, tests the lows of those break lines and forms a new high, and this bar has been made here, this fake out manipulation bar has been made, so we have a higher low. When this is done, we now have a confirmed break of structure, and based on that break of structure, we can enter. We can enter here, or we can enter at the retest of these lows somewhere higher than these lows. Best would be to enter here as price breaks out and we have our stops near these lows, and we don't have to go all the way down here. So that's how we know a structure is broken. Even in a trending market, price doing this, we know a structure is broken when we are making a series of higher lows, or in a downtrend, we are making a series of lower highs. So this is critical to understand. And then as lows are broken, of course this is a bad drawing, but this one is a good example here. As highs are broken, this maintains structure. This is structure that is maintained. So as price is testing these levels, we can enter them and we know that this structure is maintained. When price then decides to make a new lower low followed by a lower high and price keeps going down, then we know that this structure is broken. This is where that trend line comes into the picture, and when this trend line is broken and we form a lower high, then it's time for that structure to be broken. So as the longer time frame moves towards an area of value, as it approaches an area of value, which is in our example an order block, and we see a break of structure after that area of value is reached, and in an order block that means a mitigation, and we'll talk about what mitigation means in a minute. And please also refer back to the video on supply and demand that explains mitigation. And so once the mitigation has happened and we have a structure that is broken, that is when we can safely say we can enter. And we can look at the hourly or lower, but preferably we're looking at the daily and the weekly for our long-term trend and following entries only in respect to that trend. Until that daily trend is broken, we are not going to enter any position to the opposite side for now. So when trend is bullish, we enter bullish. When trend is bearish, we enter bearish. And some people, to help them understand where to enter bullish or bearish positions, and if looking at charts is a little bit more difficult, it is easier to add, depending on the currency pair you are using, depending on that currency pair, I use moving average, exponential, and I will use, usually I will use the 50 or the 200. It depends on the currency pair. You have to really know your currency pair to understand what value that currency pair respects. If it's respecting the 200, as you can see in Australian dollar, US dollar, when it's below the 200, we're only focusing on short trades. When it's above the 200, we're focusing on long trades. So you can use that, or you can just say, hey, left to right, is it up? Then it's a bullish trend. Left to right, it's down, then it's a bearish trend. And so you can then look at a series of higher highs and higher lows as a signal. Higher highs, higher lows is one structure, and then lower highs and lower lows is another structure, and then there's higher highs, lower lows. This combination just says we're in a range. So these are the three possibilities that we look at as we enter. The stronger the trend, the easier the entry. So many currency pairs, if one is in a range and you're not happy with that setup, you don't have to take that setup. You can go to the next currency pair and say, wait, I don't like this one, I'm just going to go to the next one. So nothing wrong with that decision. So just make sure you're looking at is there a series of higher highs, higher lows, lower highs, lower lows, or you're looking at the 200-day moving average. And some currency pairs might do better using the 50 period moving average. So it depends on your style. If you say, well, you know, this currency pair is actually more inclined to use the 50. Now, in this case, you can see very clearly it's all over the place. So 50 is not the right one. So you can see very, very clearly. You can try to play around with various numbers and see what it does. But for me, I just say, hey, some are 50, some are 200. If I want to be lazy and don't want to look at charts properly, but I don't like to put indicators. As you can see, my charts have no indicators. Very simple way of looking at charts. Charts respect price. Price is king. The only thing you have to understand is market structure, area of value, then you can execute. It has to be in this order. You cannot execute and then worry about structure. You cannot execute and worry about area of value. The sequence is, what is the structure? Am I respecting that structure? Am I at an area of value that at a lower time frame is breaking its own structure to help me resume the structure of my longer time frame? Well, this is it. This is the only thing you need to do. Structure, area of value, execute in this order. If you miss this order, you might as well just give your cash away to somebody and then just, you know, call it a day. This is really important. Of course, the most important thing for me is cash preservation. If you're not managing your risk, then you might as well also just throw out your money. Risk management is the #1 priority. I don't want to deviate. That's a lesson on its own. So now that we understand what break of structure means, we understand that we must break structure on the lower time frame to resume the longer time frame trend. Momentum is behind us. Then we go from the daily analysis, we can go down to a lower time frame to find our exact entry point and also our exact exit point. So we will start from there. But now, where's our starting point? Our starting point is order block. And order block is where the market takes price down to go up or takes price up to go down. So a bullish order block is the last bearish candle before highs are starting to be broken. As we start making new higher highs and price has a wild move to the upside, that is our bullish order block. Bearish order block is the last buy candle before a bearish move to the downside that starts to take out lows. And any time frame, these order blocks work. The higher the time frame, the stronger they are. And so we start with the daily order block. That's our starting point. And so what I want to do is to just randomly select a date 2 to 3 years out. The reason I say 2 to 3 years out is because I want to be able to go down to the hourly to show you a few things. So if we go too far out prior to 2017 or 2016, we might not be able to find a good way to look at the hourly. I want to show you, once a daily occurs, how can we use the hourly as our trigger? And here's why I want to use the hourly as a trigger. And it's a very simple concept, really. But if you don't have time, even an hour, like 2-3 minutes every hour during the markets you want to follow, then you just stick to the daily. What happens to the daily is, let's take this as an example. This area here. So we know, we have said, when this is broken, this is our entry signal. And as long as we are making a higher low, then we are fine. We're going to continue that bullish side. So we're making We have a low, a higher low, a higher low. We have a high, a higher high, a higher high. So this is a great place to enter. So once we enter here, where is our stop? And if we're going long from this point, and our stop is somewhere here, and as you can see, it's 117 pips. If you're doing standard lots, roughly $10 per lot, that's $1,170 of risk, because you're using the daily and your stop is based on a break of structure on the daily. This is why I prefer to use the hourly for my trigger. Of course, as I said, if you decide you only want to trade on the daily, that's perfectly acceptable. Know how much risk you have, and if you're starting with an account of 2,000, this is not an acceptable risk. This is more than 50% of your account that you will wipe out if this market goes against you. By the way, market goes against you does not mean your analysis is wrong. So let's get that psychology out of the way. That I must win at all cost is not a way of trading. The way to trade is, when I enter, I have no knowledge where the price is going to go next. I just know I'm managing my risk. Here's where I enter. Here's where I'm expecting price to go. If it doesn't go that way, here's where I'm exiting. If we're managing that risk and we can consistently be on the winning side, we can consistently follow the banks and follow their trails and enter our positions accordingly, we will be safe and we will come out ahead. So on the daily, you have a much higher risk. If we take the same position and look at the hourly, now I don't remember anymore where we were when we entered. It was somewhere in 2018, I believe. Well, it's a lot of movements. As you can see, it is not allowing me to go past January 2019. So this is where I wanted to find a date that is not too far out for our entry. So let's look at another example on the daily then. I'm going to show you another example on the daily. So we have higher lows and break of structure, and we're entering here. So let's use this as an example. We are entering here at the break of that, and here's our stop. That's 110 pips on a standard lot. That's $1,100. And if we want to make at least two to make one, this is our exit area. We barely made it. We barely made it without being stopped out. Now, so if we use this as an example, and I hope when I go to the hourly, October 2019, then I can go back to that period. I can definitely go back to that period. I believe it was somewhere here. So we can go back to it, and our goal is to find our entry. I don't know what is happening to my charts. I don't know why I am not able to find those entries. Let's go back to the daily. I apologize about this. October 18, 2019. October 18, 2019. Oh, maybe I'm looking at 2020. Maybe that's where I am wrong. Yes. That's funny. It's funny to me, maybe not to some of you. So here's where we entered on that break of structure on the daily. So we entered here when we broke structure here on the daily. This is our entry. Now, if we are looking at the hourly, we can see that there's break of structure here, break of structure here, that this downtrend has finished making its move. This downtrend has finished making its move. We finished up, we have higher low, and we have a break of structure here. We have break of structure here, or we can say we have higher lows here and here again. And so we can also see, even if we had waited, one more is a break of structure here, and we have entered. Even if we enter same spot, but we now have a much lower stop. Instead of 110 pips, it's 85 pips. But our entry is really triggered a little bit earlier, and with our stops here, 66 pips now as opposed to the 110. And now we can target that 2 for our target 1. Target 1 is 2, and target 1 is hit much sooner, much sooner. With a little bit of a drawdown, we didn't hit our stop, a little bit of a drawdown, and target 1 is hit, and we can move our stop to break even. And on the second half of our positions, we are out at break even, and price has continued to go up. And what's so good about this position is that it allows us to re-enter. When again a new break of structure occurs. Here we have now a higher low, and when we break this higher high, this new structure is broken, then we can re-enter this position. We can re-enter this position when this high is broken here, and this new entry is now with this stop of 57 pips, and we target again some more up here. Now, I'm not showing you where the target 1 is yet. I'm just saying let's make 2 when we are risking 1 at the very minimum, but a lot of times it's even higher than making 2, because we have specific areas where we are going to exit. This is just examples of how we can use the hourly for a much tighter trigger instead of waiting for the daily. So on 11th of December 2019, if we go to the daily, now here's where I have marked our entry. Our stop never gets triggered, and that's a winning trade. But we'll go into depth in just a minute. But I want to change now to the daily, and for this move on the daily, we had no entry on this move on the daily until this high is broken. So our daily entry, if we say that we want to break this structure and we want to make a new highs, on the daily, our entry would have been our re-entry, that is, would have been somewhere there with a much wider stop now, and trying to go for for that 2, which is never attained, right? We were stopped out before that happens. So this is why I like to use the daily. I know it's a very long-winded way of saying why hourly is better. Hourlies give us the turning point much quicker than the daily. This is why I like to use the hourly. So now we got that out of the way. So let's go back to January. Let's go back to January 2019. Some time here, it doesn't matter. Let's just find some time here. This is where we start. This is our starting point. And we take everything out. We take everything out. We take every drawing out. And this is our starting point. What is the structure? The structure is a downtrend. This market is in a downtrend. So what is it that I want to do? I want to short when it's possible. We are told, this is our basic training, draw the trend line, as many points as possible touching, draws its trend line, and when price hits the trend line, you're going short. This was the right decision, but your stop would have been a little bit higher than these highs, and you were stopped out. And those who said, well, the trend just got broken, trigger happy, they enter, they were stopped out, and price did make new lower low. So that's why patience and break of structure is critical. So now where do we find our zones? Where do we find our order blocks? So let's start at the highest at this point. I will not go back any further. So the bearish order block is the last bullish move before the bearish movement, and I go as high as the wick. At open to wick for bullish open to wick high, and for bearish is open to wick low, and the open at the bearish candle is at the other side, so that's why we go down. So here's one order block and every order block has to be mitigated. Why does it have to be mitigated? The banks, the smart money, the institutions, they take the price up to take it down, and both positions are open. But what they do is they put a large position up so that price keeps driving up and luring retailers with it, and they take a much larger size and price comes down when they sell at a much larger volume, much larger size, but both positions are open. So the larger volume, which is their primary position going down in this instance, is making money faster than the open bullish position that is losing money. It does not matter, both positions are going to be open because they are going to come back and mitigate those losses. They are going to make their money on the way down, and they are going to mitigate those losses. Sometimes they might just say, we have not looked past yet, right, in the future, because we have already doing a replay, so we're starting at point X backwards. So they might just say, on this day, this is far enough, we are okay with this loss. Maybe their volume for this uptrend was not as large, significantly large enough to worry about this loss, because they have made enough money on the way down. They know they're going to keep taking the price down, so they don't have to mitigate all the way. We don't know their reason. Their reason does not matter to us, but we just know that sometimes it does not get mitigated, or it takes years to get mitigated. Either way, it's okay, because they have the deep pockets to wait for that as they're making money on their primary position. That's important to remember. So we have our first order block, our bearish order block drawn here. Our second one is this order block here. And this one almost mitigated, almost. If, I have seen some people draw the order block from the first candle that started that move. If that's the way you draw it, there's no right or wrong here. For me, it's just finding that balance. If that's the way you draw it, it's mitigated. All it has to do is touch and it is mitigated. But this is how I draw it. I want this to be mitigated. And for me to have an entry, it's okay if I miss this entry because of the way I draw it. For me to have an entry, I need price to penetrate this order block first. Before I look at break of structure, I need this to be broken. That's really number one for me. So this is not broken. This is not broken. So far, no entry for me. So, every day, right? Every day I'm here, and your order blocks is only drawn after a move has occurred, right? So I'm here this day. I've drawn this order block. I've drawn this order block, and I'm just waiting to see what happens. So, but because we started at some day X, I'm always going to look back and draw all my order blocks. And then starting from that point forward, as we go day by day, we will make our decision. And so here we have another order block right here. We have another order block right here. And let's take out this trend line, because that's not what we're using to trade. We're using just these order blocks. So we have this order block here. Plenty of order blocks to play from once we start moving forward. So what I want to do is, as we move forward, I want to show you how I pull my triggers on a day-by-day basis. And here we have, now in my instance, when candles are smaller, I might use just a couple of candles to give me a wider order block. Now, as soon as this order block that I see it is mitigated, I don't need to draw the lower ones because I know they're already mitigated. And when we start getting near entries, then I will draw the bullish order blocks, because that would be my first target one. If it's close enough. If it's not close enough, first target is first sign of trouble, meaning is there any resistance support line that I can go after. That would be my first target. And then the next order block would be target 2, target 3. So I know this has been mitigated, so no need to worry about those. And then here now, once that is mitigated, this is out, but then I have this new ones here. I have these new ones here, and I have another one here. And this one is already mitigated. And then I have another. Now these were indecision bars, so you can take it from here or from the lows here. Either one works. Whatever one makes you comfortable, that's the one you draw it. So now we are ready, right? We are ready to play forward and make decisions. So remember what I said. The structure is down. I'm expecting to go down again. We are in a consolidation in this area. This is a consolidation area. Price could go either way. It could go up, it could go down. When price reverses and pulls back into this zone, I want to see a break of structure to tell me it's time to enter short. If I don't see a break of structure, I'm not entering long. I'm just waiting at the next order block. Is there another break of structure from that pullback? Is there a break of structure from that pullback? By the time you clear 2 or 3 order blocks, it might be time for price to reverse. And if that happens, then now we will look at the bullish trends. But until that happens, we're only focusing on what we see on the charts. We don't care why price is going down. We just care what the charts are telling us. We care what the banks are doing, and we just want to follow them. And one more thing I want to add here. When you start to see double bottoms, double tops, and these are areas, right? They're not perfect points. Double tops, double bottoms are areas where majority retailer is taught to take action. So, oh, we reach, see, let me zoom out here. Let me zoom out. Look at this one. Look at this manipulation. Look at how beautifully this is manipulated. So price comes to an area of value. For most people, the area of value is that support. And boom, I'm going to enter long, right? Here's my area of value, I'm entering long. Here's my stop. Here's my exit. First sign of trouble is somewhere here. Beautiful. I'm going to make 2.81 for every one that I risk. But here's why this is wrong. It got stopped out. It didn't even go halfway there. It got stopped out because of the manipulation. Now look how beautifully this got stopped out. And what I say beautifully is this really shows you the power of the manipulation, the power of the banks. We're at an area of value. The longs just got wiped out. And with this next bar, now we enter short. A lot of people have said, hey, this is so beautiful, I'm going to enter short. So let me take this. Oh, what happened there? Let's take this out. Let's shorten this to the actual bar. Has closed at this bar. So now let's enter short when this got broken. And I'm going to put my stops right above here. And I'm targeting, 2. In this instance, you are lucky because it took the price far enough. Unless this is an anomaly, right? Sometimes there's these weird bars that you might not see in other brokers. So if that's the case, this traders also got stopped out. Or if they were going for, oh, I want this a home run, I want 5-1, 6-1, and price quickly reversed that day. But here's an example where price reversed. Whether you won this trade or not, price reversed and went back inside the zone. So these 2 trades are examples of the manipulation that has taken place. A lot of times you don't see this length of manipulation. Price goes back in right away, and so we want a break of structure. So this area here, this double tops, double bottoms, is liquidity. Liquidity meaning banks know there are stops that they can come after. When this happens, they go clear out those stops, collect their money. And this liquidity works on both sides. There are stops here, and then there's stops for those who enter here. There's stops above. So there's liquidity on both sides of that support and resistance. So keep that in mind as you are looking at double tops, double bottoms. When there are, especially when they're really equal highs and lows, those become much, much stronger. And here again, look at this play out where people who went long here, right when this touched, hoping that price, this is what they were hoping, right? First sign of trouble here. Here's what they were hoping, but the very next bar, they got stopped out, right? This is close for a loss. And then same thing is those short entries at this very next bar that went short when the lows were broken. The very next bar, when they were maybe high here, because they saw these highs, they were also stopped out, right? Now this is even a much better example than the one I just showed earlier, where price got manipulated. Longs got manipulated out, shorts got manipulated out, and now we're anticipating price is going to resume back to the order blocks, because it does move from order block to order block. This has got to be mitigated. This entry has to be mitigated. It has to, but it might not. And so now our goal is, now that you have seen the power of this manipulation, our goal is to go day by day and play out what happens when we come back to the zone. So I'll play it a little bit faster to go back to the zone. As you can see, price continues to go down. They were manipulated out on both sides, but price went in their direction, but they were already manipulated out. And for me, I don't know where that's going to happen, so I just wait for those order blocks to be hit. So here's another order block now that we have seen price has gone down. However, this order block is already mitigated. Once an order block is mitigated, I usually delete it, but they might come back and decide, you know what, we want more out of this mitigation. They might still have more positions left, and they might not have completely mitigated, and they might go halfway through. So as a result, I just want to leave it until it is at least halfway through that mitigation. It might not happen, but I just wait. For me, I just wait and let price tell me what it wants to do. And as price is moving from mitigation to mitigation, here's one that we missed, that I missed drawing. This one right here. So this one right here got mitigated. And now, because I already saw price going down, I don't want to use this as an example because I missed showing you this mitigation area. I want to show you where one is. I don't know what's happening next, and we enter based on break of structure. So that's, sometimes I like to play it a little bit slower so I can catch those. So this, now we know this is mitigated. However, we have created a new one right here. We have created a new one right here. So what I want to see now, I'm going to play it a little bit slower. I want to see price enter this and this order block. I want to see go down to the hourly chart and find the break of structure of this pullback to enter on the short side. If that break of structure does not take place, we don't enter this trade. So boom, boom, we are in this mitigation. Now I change to, so let's remember it's the last date here, so we don't have to worry about going back. We just switch to hourly. And this is where we are. And you see how on the hourly, we've been going inside this order block over a period of many, many hours. Each line here that you see here is day markers. So we're going from one day to the next, and we're grinding up and, you know, grinding up, continuing this pullback, right? Higher lows, higher lows, higher highs, higher lows. This is where we are in that hourly. So what I want to see is a break of structure of this trend line. I want this trend line broken for me to say there's still more downside to this market. So we're playing around this trend line. I want to see, so break of structure now means we form a lower low and then we form a lower high. That's critical. If we don't do that, there's no break of structure. Again, a lower low from here is break of structure. Until that, there's no break of structure. There's no entry to the long side because my long-term outlook is bearish. Long-term outlook is bearish. So here's a low. Here's one lower low that's about to come down. Here's another example of price manipulation. Even those people who understand order block, who do not have the patience to wait for a structure that is broken, right? A structure broken means a new structure is formed. People who do not wait for a new structure to be formed, here's where they get it wrong. They see a break outside of the order block. They enter long. They put their stop near these lows. They want to make at least 2. They put their targets there. And what happens? They get stopped out. They get stopped out because they were not patient enough to understand that the long-term structure is down and they are not breaking a pullback structure. They're actually thinking this is a continuation. And I don't like entering continuation in a downtrend and an uptrend continuation. That's counter trend. That is saying, oh, I know that the trend has reversed. There's nothing in the charts on the daily that have told us that this trend has reversed. See, if you're only looking at it here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, yes, it's an uptrend. But if you're looking at it from a long-term perspective, we are still not making, new highs yet. We have got to clear still a few highs before this trend is reversed. It could happen. This could be the start of that reversal. But until we have a strong confirmation we're in a good uptrend, meaning maybe as we break these highs, right? This is a good break of structure. Like this is broken. It's a good break of structure. These highs are broken. Price continues up a little bit. Price comes down, retests those highs and reverses. Maybe this is a safe area to assume that we are going to be making at least new highs for now, especially as we break these highs. And now we can target some other highs up here. So until that happens, I'm not there ready. I'm not thinking we are yet at that place. So that's why I'm not entering long. I'm not entering short until my short now is a break of structure. A break of structure meaning I need to see a new lower low and a new lower high formed before I enter. So let's go one by one. Lower low, we now have a break of structure. Will this break of structure hold? The only way we know is we form a higher low, and we form a lower low. That's how we know this break of structure has occurred. So let's go one by one. we're looking at the hourly because this is our trigger. Our daily has already said, I have entered an order block. I could go down because the overall market is down, but I could be reversing. So I need a confirmation of that reversal. And it is perfectly fine to get it wrong at times. So here we consolidated and made a new low. So at this point, I am comfortable entering a short position here, having these recent highs here or here. Either one works. 19 pips or 15 pips. Let's go for about 20, and we go these areas here, this areas here, somewhere here is a looks like a support area. So we go there, and this is almost 2 for 1. If we tighten this up, it's even better than that, but I want to give myself a little bit wiggle room, and let's see what price does. When I'm entering this position, this is my expectation. I have now a much tighter stop, and I am not losing sleep over this position. This is 19 pips. It's $190 on a full lot. So I'm not losing sleep over $190, right? This is how you manage your risk. And you can do a full size lot with 19 pips. A full size lot with 100 pips is a different story. So now we have this break of structure, and if this break of structure holds, we're in business. If this break of structure doesn't hold, we're stopped out, and that's okay. But as you can see, we're making lower lows, and boom, our position is closed. Our position, half of our position is closed for target 1. And now at this moment, I am going to enter a second one at the exact same spot, because this is my other 50%, and my expectation on the second one is to go to the next area of trouble, which is somewhere here. This is my expectation, and my stop now is at break even. My stop is at break even. I can play it out, and I'm okay either side because 50% of my position has hit the target. And as you can see, I could be stopped out. It's kind of hard to see. Yes, I'm already stopped out of that position. Because it's hard to see, I think I'll just, yeah, it's okay. So second position is out at break even. First position is out at our first target. So this is the idea. Break of structure, and we enter on a very tight stop. Break of structure. And now I'll just play it forward a little bit faster, and as you can see, sometimes the reason why we take the second position at break even is price could reverse on us like it did here, so we don't want to be on the losing side. And I don't have any clear indication of where the market is going. These longs here that have been stopped out are already hurting because they see price has come back. They say, oh, I should have made my stop wider, but how wide do you go before you feel the pain? And again, price broke out, and if you don't see any clear break of structure, and let me pause it here, So here, if you really want to enter this long, if you're saying, okay, it came here once, it came back again here, and you know, here's a you know, somewhere here, here's a double top on a closed basis, there's some liquidity here. If you want to enter this, what you want to see is price has made a new high, but price has made a new lower low. So there's no safety, and this is where you would enter. This is the only place for me where I say, after this down move, this is the only place I could enter. But this down move now was past the lower, so because of a lower low, this is also negated. So there's still no entry on the long side at the break of this order block. We have made a new lower low, and as price continues to move, are we making higher low and higher high? You see, we're not. I still don't see any reason to enter long yet. All these positions are faking people in to go long, and here's a funny part. Of course, not funny for those who have entered long here at this break, and you know, they would want something like this. Their stop is somewhere here, and their position is, at least when they want to, is somewhere here, and you know, because looking back, they'll say, well, it's been a long time, so they want to target these highs, right? These highs. So some might have been lucky to get out sooner, and some who have said, I really need to make that too, they stayed in the trade and they got stopped out. And then again, those traders who said, oh, it's going short and I'm going to put my stop right above here, they got stopped out. Two sides of the trades got stopped out, and one side was right in their decision, but they just got stopped out because they entered too quickly. Too quickly meaning, here's the right entry. Here's the right entry for this short. Price went down, price retested, and when price breaks this low is when you enter. So that didn't happen, and so price went up again, and now when price breaks this low is when you enter. This is when you re-enter here. Again, I did not show you this entry, so I'm not going to go back and say, oh, let's replay it. No, because think of it this way. I come back, price is here, oh, I have missed this trade. That's how I want to think of it, even in this example. Even knowing that I could go back and I'm showing you where the exact entry is, I am saying, oh, I was asleep, I was doing some other work, I missed this trade, and now I just wait for my next trade setup. And so price continues to move in this range here. So we'll play it a little bit faster. I know this video is kind of long, but I really want to show you the strengths of this movements. And let's pause and go back to the daily. We go back to the reason why I want to go back to the daily is to find our order block. So this has been mitigated. This line was just to show you liquidity. So where is our next order block? Our next order block that we just formed is here. But I don't want to draw it yet because we have not made a new low. So we have an order block here, the last bearish bar before the bullish movement. So let's take out everything here, and now we want to see what price will do when we reach this order block. Now this order block is our exit, right? This is really when any place that we enter, so as we have entered some positions and we got stopped out. But anywhere that we enter, if we don't get stopped out, our primary exit, while it is first sign of trouble and we keep going down from first sign of trouble to the next sign of trouble, next sign of trouble, our preferred final exit is the next order block. So as we're moving from order block to order block, that's what we see price do. So let's play it. We pause. The reason why I pause now is because now we have confirmed order block right here. I want to take out everything that shows past. We've gone through those examples. So here's an order block. So now I have these two order blocks and I want to see what price does when it reaches these order blocks. I am not entering any position in this order block. I'm only entering position in this order block because my bias is still to the downside. Even when you're looking just a few months back, we're still in a downward movement. That pressure is still downward. So I can play here and stop right here. We have just mitigated this order block. Now I want to go to the hourly and find my entry. What is my entry? This whole pullback, I want to see break of structure. I want to see break of structure of this whole pullback. So we've broken the trend line. Now I want to see a good lower high for price continuation, where I would want to enter here, and my risk would be this here. This would be my risk to go to somewhere in this area. That's what I'm looking for. So let's see how it plays out. Let's see if we get, so here's an early indication of what I'm expecting for my entry. We have a high, we have a lower high, we have a lower low. You could say the break of structure has already happened. Why didn't you enter here? That's a valid question. I saw this as a consolidation, and plus as we were playing it fast, I kind of missed it. So that's a combination of those two. Even if we were not playing it fast, I want to see a little bit of a pullback to this zone, and I'm going to enter short on the next opportunity. So here's price coming up. So boom. So just like I mentioned, we have a higher high, and here's our entry. Here's our entry. Here's our stop. We have an 11 pip stop, and our first sign of trouble is in this area. So I'm just going to pull this up a little bit. It's at least risking 11 pips to make 23 pips. This is for me a good risk reward, and we play it out and see what happens. See what happens. Price is moving sideways. Price is we got stopped out. We got stopped out, but that's okay, right? This is because we are expecting not perfection. We got stopped out. Now here's another stop that did not get triggered. Remember earlier our 19 pip stop? So this is the difference between this small shorter stop and a little bit wider stop. And let's play it out and see if we were right in our initial assessment that price is going to go down. But instead of doing that, even the second stop would have been triggered and we would have been stopped out. So it is perfectly fine to be stopped out. It's not about 100% win rate, it's about consistency. And I'm going to pause, go back to, so we have this loss, but we're okay with that. because of consistency. Now let's go back to the daily, and I'm going to stop this soon. I believe you're getting the idea here. See how price faked out and came back down again? There's a lot of times we're seeing these fake outs and coming back down. Fake outs coming back down. So I want to pause. This has been mitigated. So let's draw a couple of order blocks, and we can call this training good because you're starting to see the idea. So this order block is already mitigated. It went up, it went down. This order block is already mitigated. Now I want to see, ideally, I want to see price come back here for a good entry, or we have no entry. Remember, this is not the only chart we monitor on a daily basis, right? We're monitoring a set of currency pairs. We're monitoring crypto, we're monitoring stocks, ETFs, futures. So there's always plenty of opportunity to make money, but this is just a good example how order block, break of structure is a way to pinpoint entries and minimize losses to maximize gains. So our entry was the right entry, with the exception of this head fake out that stopped us out and really went in our direction, but that is expected. That is expected. So as we play this out, we want to find next area of order blocks that we're hitting. There's nothing that shows any clear indication for me to enter. I don't chase. If I'm not an order block, I'm not entering. I don't chase, and I wait. I wait and find order blocks. I stop here. Here's my next order block. So these are all small indecision candles, so I can use them together. Here's my order block. I want to see what price does when it enters this order block. Remember, I don't enter long positions in a downward biased market. I only enter short positions. When I'm in an order block, I will pause and I will go to the hourly. I want to see price enter here, break of structure, higher high, break of structure, lower high, break of structure. This is my entry. This is my entry. Even though price is pulling back, this is in a real market scenario. I was already entering here. So I'm going to enter it here. I don't know what price is going to do. I don't know if it will hit my stop. So I could use 15 or I could use 19. Either side works. I'll use 15 again. This is a 14, 15 area. So this first sign of trouble right here is price is a little bit too low. This is my first target. So as soon as we hit first target, we can call this training good because the next target is lower down and we have a break even. So whichever one gets hit doesn't matter. So now we just wait for price to tell us what it wants to do. So we almost came to our target. Once, twice, we hit our target. And now I'll just extend this, just so you know, this is the next area. And here's our break even. This is our second portion of the trade. We could get stopped out, or it could continue to hit our target 2. And at target 2, we can take off the rest of the positions, or we can take off another 25% or so, and just keep waiting it out. But target 1 is already hit in this position, and because we were patient enough to wait for that trigger point of break of structure, a lower time frame break of structure that shows a continuation of the structure of the long-term momentum. So here we're able to sleep at night with this position. We took a 15 pips risk and we can walk away. We walk away, we don't monitor it, nothing is wrong, right? And the second 50% of our trade, we've already made money. And so we're exiting on the second portion of our trade, and we're exiting at break even. And I usually do a little bit better than break even. What I do is, just to show you, I'll just show you what I do. Once I enter a position and I hit target 1, my second lot, I'm actually going to put it, so if I hit my target 1, and let's just say as an example to make it easier to see it on this chart, let's say this was my entry. Let's say this was my entry and target 1 hits here. Let's say I hit target 1 here. My stop loss then for the next one is a little bit lower than my entry, right about here, so that even my second half of my position makes money. Even if it's $2, it is making money. That's how I position it. This is how I'm able to be more consistent over time, because those risk one make 2, half of them are already making that. The second half is risking nothing and actually making a little bit of money so that I can continue to trade. So I hope this is helpful. Order blocks, very important. Go from order block to order block. Entries happen inside an order block or right outside of it in the direction we want to go. Entries happen at the break of structure of the lower time frame. If you wait for a break of structure of your analysis time frame, your risk is much wider. As you can see, we were able to take $150 risk on a full size lot, and if we multiply that by 2 lots to have a 50% exit, a $300 risk on 2 lots, because we were able to go to the hourly time frame. Somebody who can go down to the 15 minutes time frame might be able to take this $300 risk to maybe $100 risk, maybe $75 risks. You could do 5-6 pips. I don't recommend trying to go for 5 pips, because here we already have like a 4 pip spread. So trying to go for 5 pips is risking the spread, because sometimes during middle of the night when the market conditions are not as volatile, the spread could be wider and you will be susceptible to spread taking you out. Just because of spread you're out, but your overall analysis is spot on, the direction is spot on, it never comes close to your exit, with the exception of the spread exiting you out. So you want to make sure that you give it enough breathing room, no matter what time frame you're trading. Give it enough breathing room, let it have that playing room, and then you hit your target because of break of structure. Break of structure, the most important part for your entry, but that is the second most important part, because the primary objective is preserving your capital. Risk management all the time. Risk management, risk management, risk management. no matter what instrument you trade, if you don't manage your risk, you will wipe out your account in no time. So why do most Forex traders lose money? It's because they don't understand the concept of price manipulation. They don't understand the concept of following banks to enter their trades. They're following the traditional teaching, buy low, sell high, support resistance, but support resistance gets manipulated and they will get manipulated out. And if you want to understand a lot more about where this manipulation occurs, in an accumulation phase, if you study Wyckoff and do a lot of research on Wyckoff, I have a video on Wyckoff. If you do that study, in an accumulation phase, there's a part of where it says terminal shakeout. This is where it fakes people out thinking I'm going to go down further to reverse, and taking out both the longs that have a stop loss and the shorts that see a new direction. They think they see a new direction and they have a stop loss on the other side. They both get taken out. The banks collect that money and they drive the price up on the other side. And in a distribution phase, the opposite happens. Price tests some highs and then it has an upthrust, a second upthrust above the distribution area that UTAD. Once people see the UTAD, they say, oh, it's a reversal. They enter long, they get wiped out. And the shorts that were short at the high before the UTAD also get wiped out, because when the UTAD happens, their stops get hit. So understand the idea of price manipulation. And the word manipulation might seem harsh, but it is a true manipulation. Price is manipulated. The smart money, the banks and institutions, are buying to go short. They're buying first. They're selling to go long because they're selling first. They fake everyone, unsuspecting retailers out, and they take the price up. They have liquidity. For them, it's about liquidity. And liquidity, as I said, is when we start seeing some equal lows here in this zone. And lows is a zone, is not an exact science, but here we have liquidity. Here we have liquidity, so at some point they might come and collect this liquidity. We have liquidity up here when these, you see this double top here, we know it's a liquidity that they're going to come after, so they came after it and collected this liquidity. Some people, the way they trade on a daily basis, right, because this is 1, 2, 3, 4 days, their targets might be way down here and they don't have any trade management, and so they're still sitting here with this liquidity. There's a lot of people with that liquidity, and this liquidity is ripe for the picking. So people come, smart money comes and collects this liquidity. People get stopped out, and here price gets manipulated very easily. You can see we think it's a breakout, so longs get in and they get stopped out. Shorts were in here and they made money for a little bit because their target is somewhere down here. If their managing is right, not all the way down here, their target is somewhere down here. But the very same day, maybe during their sleep time or maybe during their lunch break, their coffee break, they get wiped out. So we have this liquidity, this manipulation. If you don't understand this manipulation, you are going to close your account, not by choice but by force. So remember, liquidity, order blocks, structure, break of structure. If you understand these concepts, then your entries are going to be very, very precise. Sniper entries, very precise, low risk, high reward. And sometimes you will get those 5, 6, 10, 20 point reward to one risk. But our goal is to start, somewhere a little bit above 2, preferably, but even 2 is enough for us. So 50% of our position comes off at that risk 1, take 2. Once we get 2, 50% is off. The other position is moved a little bit better than break even, so that the whole trade becomes profitable. Rinse and repeat. Rinse and repeat. Order blocks, liquidity, structure, break of structure. All right, everyone. If you have any questions, please feel free to leave comments, and I will come back to you soon with more learning. Take care.